Financial freedom, a state where an individual has enough income or savings to cover living expenses without being dependent on active work, allowing more life choices. Passive income, earnings derived from investments or business activities in which the individual is not actively involved, such as rental income or dividends. Market trends, the general direction in which a market or asset price is moving, influenced by factors like economic data, investor sentiment, and global events. Risk management, the process of identifying, assessing, and controlling risks in investment decisions. It involves balancing potential returns against potential losses. Capital gains, the profit made from the sale of an asset such as stocks, bonds, or real estate when sold for more than the purchase price. Long-term investing, a strategy of holding investments for an extended period, usually years or decades, to benefit from the compound growth and market appreciation. Stock analysis, the process of evaluating a company's financial data, market position, and future potential to make informed decisions about buying or selling its stock. Stock, a share in the ownership of a company. It represents a claim on part of the company's assets and earnings. Share, a single unit of stock, representing an equal part of a company's capital. Stock exchange, a marketplace where stocks are bought and sold, such as the New York Stock Exchange, NYSE, or NASDAQ. Market capitalization, market cap, the total value of a company's outstanding shares of stock, calculated by multiplying the current share price by the number of shares. IPO, initial public offering, the first time a company offers its stock for sale to the public. Dividend, a portion of a company's earnings distributed to shareholders, usually in cash or additional shares. Bull market, a market condition where stock prices are rising or expected to rise, where stock prices are falling or expected to fall. Bid price, the price at which a buyer is willing to purchase a stock. Ask price, the price at which a seller is willing to sell a stock. Spread, the difference between the bid price and the ask price. Volume, the number of shares traded in a given period. Volatility, a measure of how much a stock's price fluctuates. P/E ratio, price to earnings ratio, a ratio for valuing a company, calculated by dividing its current stock price by its earnings per share EPS. EPS, earnings per share, the portion of a company's profit allocated to each outstanding share of stock. Blue chip stocks, shares of large, reputable companies with a long history of stable earnings and dividends. Growth stocks, stocks of companies expected to grow at an above-average rate compared to others, often reinvesting earnings instead of paying dividends. Value stocks, stocks that are trading for less than their intrinsic or book value, often seen as bargains. Index, a benchmark that measures the performance of a group of stocks, such as the S&P 500 or Dow Jones Industrial. Portfolio, a collection of financial investments like stocks, bonds, or other assets. Broker, a person or firm that buys and sells stocks on behalf of an investor. Limit order, an order to buy or sell a stock at a specific price or better. Market order, an order to buy or sell a stock immediately at the current market price. Short selling, borrowing shares to sell them with the intention of buying them back later at a lower price to make a profit. Capital gains, the profit made from selling a stock for more than its purchase price. The key difference between stocks and bonds lies in ownership and debt. Stocks represent partial ownership in a company, meaning when you buy stocks, you become a shareholder with a claim on the company's assets and profits. Stocks can rise or fall in value, offering the potential for higher returns but with greater risk. You may also receive dividends if the company shares profits with its shareholders. Bonds, on the other hand, are essentially loans you give to a company or government in exchange for periodic interest payments. When you buy a bond, you're lending money for a set period. The borrower agrees to pay you back the principal, the amount you invested at a later date, plus interest, typically paid annually or semi-annually. Bonds are considered safer than stocks but usually offer lower returns. In the case of bankruptcy, bondholders are paid before stockholders, adding an additional layer of security to bond investments. Finance, the management of money, including investing, borrowing, saving, budgeting, and forecasting. It encompasses personal, corporate, and public finance sectors. Wealth, the abundance of valuable resources or assets including money, property, investments, and material possessions accumulated over time. Dividends, a portion of a company's earnings distributed to shareholders,